In the last video that I produced, we were looking at the balance of payments. So we're looking at things like the current account, we were looking at the capital account, and we were looking at the financial account. Now, just as a quick reminder, when you look at the balance of payments, we have to try and make it balanced to balance our books as an economy. In Britain, we have this huge deficit on the current account. We are talking at the moment, we're talking probably £80 billion per year is our deficit on the current account. So all this basically means that when you sum up the money flowing into our economy, so that's in terms of exports of goods and services, the investment incomes, which is money earned on loans that we have abroad, or this could be on portfolio, so stocks of shares that people have got that they own from abroad, that the profits flow back into Britain, so the dividends basically, and the current transfers, which is normally linked to international aid. Okay, so the UK economy will export lots of goods, they will export lots of services, they will generate incomes from investments they have abroad, and we will receive some money in current transfers from things like the European Union. What you would then do, you'd then minus what leaves the economy. So this would be the imports of goods and services, the foreign incomes that flow back out of Britain, that go back abroad, so people across the world have got investments in the UK economy, and then you have current transfers, so aid leaving the UK economy. So the UK, there or thereabouts, about £80 billion deficit on this. So we are talking probably something in the line of about 5% of GDP. Okay, now if that was the full story, what this would basically mean is that in the UK there'd be a net outflow of income. More money is leaving than what's coming in. So we're not basically paying our way in the world. If this was the full story, we'd be living beyond our means. It would mean our economy would soon run out of reserves of foreign currency, which is ultimately what you need to be able to buy your imports in the first place. If this was the full story, what would happen is the pound would depreciate across the world. It would lose value because there would basically be an excess supply of pounds. So if there's a bigger supply than there is demand, because no one wants our money, because no one wants to buy our stuff or invest here, then ultimately, to find its equilibrium point, the value would need to fall. But what we have as well are the capital and financial accounts. Now, the capital account is a very, very small account. It's not one that has a major impact on the economy. This is basically when migrants come to an economy, change their nationality, so a French person becomes British, for example, the assets they own will be transferred to that nation that they've now taken nationality of. So lots of people from, let's say, East Europe or China, wherever it is, if they move to the UK, their assets that they bring with them now become assets of the British economy. The financial account is far, far bigger. So for the UK economy, we are seen as a relatively safe haven across the world with a stable currency. So you might have hot money flowing in. So short-term investments that flood into the economy in order to benefit from things like interest rate increases or potential currency appreciations. What we're mainly looking at here, though, is things like foreign direct investment and portfolio investment. Okay, so when people across the world buy shares in British companies, then it's an injection of cash into the British economy. FDI, when foreign nationals or foreign firms, governments, whoever it may be, if they set up industries in the UK economy, then it would be foreign direct investment. Now the UK, roughly, once you take into account errors and emissions, the UK attracts about £80 billion a year. So that basically means that we're paying our way in the world through a capital and financial account surplus. We're sucking in investments and loans from across the world into Britain, which is basically propping up our balance of payments. Okay, so we haven't got that excess supply of currency that we would have with the current account deficit because people across the world demand pounds to invest their money here, basically. Britain is basically a good place to invest for many people across the world. Now, what we need to be thinking about now, is it bad to have a current account deficit? We've got a very large one. We've had it, well, if you know, thinking about A-level students your entire life. So it's not a new thing to Britain, and it's something that's getting bigger and bigger and bigger. Now, let's think about, is it bad? Well, on the face of it, you kind of say, yeah, it sounds terrible, doesn't it? Okay, but what I would say is, we've had it for a long, long time, and it doesn't seem to have any kind of real impact on the economy. Okay, so it's been growing for the last 15 years, but if you disregard the recession years, you know, let's go up to 2007, for example, then the UK economy performed really, really well, even with this big current account deficit. But what I would say is that historically, when we've had these things in the past, in the 50s, 60s, then it did create crisis in the UK economy, and it did lead to the pound losing a lot of value. Okay, now let's think about when it is okay. So when it's not necessarily a bad thing to have a trade deficit. If it's a short term and it's simply linked to the economic cycle, then many would say it's not a bad thing. So when you think about it, in a time of economic boom, there'll be high demand for goods and services. So naturally people buy lots and lots and lots and lots of imports from across the world, which can lead to a trade deficit. But then as the economy enters recession, this problem will tend to correct itself because recession, people are poorer, they can afford to buy fewer imports, and the current account deficit should start to tumble. A lot of people say as well, you've got to think about, well, what are you buying? What are you spending your money on? Okay, so what are you importing into your economy? So if you're importing infrastructure, so capital, then people say it's a good thing. So what it will do, it will boost the productivity of the economy. And it could mean in the future that because of that, you can export more, you've got new comparative advantages, lower cost of production, which should hopefully mean that wages start to grow as well. So for example, if we're importing lots and lots of production line equipment, for example, to boost the productivity of UK industry, then we would say, well, that's not a bad thing. Okay, now we would also say as well, this is where Britain's sort of big benefit comes in. If you've got a huge surplus on the financial account, does it really matter? Well, many would say no. Okay, it's propping up the current account. It does mean you've got more foreign investment in your economy, but by now we should realise that foreign investment can create lots of benefits for an economy as well. Let's now think though about why it could be a bad thing. So the dangers of running such a big current account deficit. First one, if it's a long-term trade deficit, then it suggests that there are structural problems in your economy. It basically suggests that you as an economy have got very few comparative advantages. You're not regarded as a competitive nation. Okay, so that could mean that in the long run that foreign investors will not want to keep putting money into the UK economy. It could mean that people across the world think, you know what, I don't want to keep investing in the UK economy. It's not a very good place to be. Now, if that happens, then it could lead to the pound plummeting in value. Because ultimately, if you've got lots of imports coming in, you're trying to sell pounds across the world to buy foreign currency, but nobody wants to buy your pounds. So the excess supply will push down the value of the pound sterling, basically. A lot of people say as well that if you've got a huge trade deficit, it suggests that what you've got is a very unbalanced economy. It basically means that in your economy, consumer demand is too high. Okay, so you're unable to meet people's wants and needs from within your own economy, so people have got this big thirst for goods from across the world, which will lead to high debt problems. Okay, so we're seeing growing problems of people stuck in debt poverty where they can't afford repayments on debt. The UK economy will overall become crippled with debt if this trade deficit was to keep growing. And then output and jobs. Okay, if you are reliant on lots and lots of cheap goods from across the world, then ultimately you're not producing it yourself. It can cut your output, which can cost people's jobs. Now, linked to that one as well, think about the exchange rate. If the pound plummets in value, it means that your inputs will start to become more expensive over time. If your inputs start to become more expensive, you have lots of cost push inflation. Okay, it pushes up price levels, and it could have another negative impact on people's real incomes, the output of the economy, and jobs within the economy as well. Okay, so overall, looking at it, you would say at the moment it appears to be okay. But for Britain, it is propped up by that surplus on the financial account. And what you've got to keep questioning is, will foreign investors want to keep investing into the UK economy? The answer could be not. And if that happens, then what will have to happen is the pound will lose lots of value.